My name is Steve Hanrahan. I'm the Advocacy Manager for TIA and Facilitator for today's webinar. TIA are pleased to bring you this webinar in partnership with our strategic partner, Marsh. Marsh is the world's leading insurance broker and risk advisor, serving commercial and individual clients with data-driven risk solutions and advisory services. Today's webinar is on hardening property insurance market and how to maximise your insurance protection. And our presenters today are Justin Armagnacq, who is the head of Marsh Placement, Don Howes, Central Regional Manager, and we may also be joined later by Kevin Kerr, who's the Regional Sales Manager. Following the presentation, there will be the opportunity for some Q&A, so please note the Q&A button at the base of the screen and send your questions through. And the webinar is scheduled for 30 minutes. I'd now like to introduce Adam Wilson. Adam's the Senior Risk Advisor in Marsh, and he'll introduce himself before we get started. So Adam, over to you.
Thanks, Steve. It's just a really quick intro from me. Myself and Deb Fisher are the key support for TIA and their members. I've got an extensive background in tourism, and before moving into Marsh, I spent 15 years in the industry. And recently we've established a tourism centre of excellence based out of Queenstown. We also have support in all regions with brokers spread throughout New Zealand. So plenty of support if TIA members need to meet locally with anyone in the area. Apologies, Deb can't make it today, but she will be on board with some of the following webinars. So that's it from me. I'm going to pass over to Don, who's going to crack into the content.
Thanks, mate. And thanks very much for all your time to come and listen to some of the things we've got to say. Hopefully you find it educational and useful. As I say, hopefully our colleague Kevin Kerr will be joining us, but if he doesn't, I will pick up his parts of the presentation as we go through. So just to give you an overview of what we want to talk about today, we're going to talk a wee bit about the impact of the global insurance markets of not just COVID, but some of the things that we've seen happen over the last 10 years globally, including obviously the earthquakes we've suffered here and in Japan and other disasters around the world and the impacts those have had. And I'll hand over to Justin shortly to talk through that. And then we'll come back and I'll talk a wee bit about some of the renewal strategies we can adopt to help and assist you in dealing with some of the pretty serious circumstances I guess you're all facing at the moment. If Kevin's back, he'll talk a wee bit around some other things there, but I'll pick up those if he's not. So we'll look at some alternative strategies in terms of minimising costs and assisting coverage. And then we'll finish up by just having a quick look at what's in the Marsh toolkit in terms of other things that we can do externally to just insurance placements to assist with the challenges you're facing at the moment. So, so Justin, if I just pass on to you and we can carry on from there. So,
fantastic. Thank you, John. And good afternoon, everyone. Yeah, as mentioned, my name's Justin Armagnacq. I'm the placement leader for Marsh in New Zealand. Just quickly, placement is essentially a market-facing role. So I'm less concerned on my day-to-day of speaking to clients. I'm more a role that is negotiating with insurers on a daily basis. And so therefore, I've got a unique sort of perspective of the insurance market and the I suppose the economics that sit in behind it that causes the fluctuations and the difficult trading conditions that we've dealt with for the last few years. When I talk about the insurance market, I do like to work from a global perspective first, and then come to what that means for New Zealand. The reason for that being that the New Zealand insurance market, I guess the capital that underlies our market doesn't reside in New Zealand. It is offshore. You think of our large insurance players here, the likes of Vero, NZI, QBE. They're all they're all headquartered out of Australia. And those companies buy some of the largest reinsurance treaty protections in the world, and they go into the international insurance market to buy those. So essentially what happens on the global stage for the insurance industry finds its way down here to New Zealand. So, you know, if I start to talk about the factors affecting the insurance industry globally at present, look, it's been predicated really on a significant amount of capital that's been in the marketplace now for a number of years. Very well capitalised marketplace. And the reason for this has been the low interest rate environment globally for a number of years. So capital has been looking for a new home and places where they can get better returns. So they've gone to industries that they didn't normally look to invest in previously. And the insurance industry is one such industry. And so this capital's come in. It's been termed convergence capital because it's not like traditional reinsurance support. It's the likes of kind of weather bonds and insurance-linked securities, parametric trigger products, and what's essentially happened is this capacity's come in. It's created competition. It's meant that the industry is really well capitalised now for a number of years, despite a significant incidence of losses, particularly through 2017 and 2018. There's been a great deal of natural catastrophes and weather events. Think of the hurricanes at the back end of 2017. There's been Californian bushfires. There's been a number of cyclones that have ripped through the Pacific, typhoons in Japan. So despite all of that, and I guess it's, you know, what's buoyed the industry through that time, they've been able to respond to those losses because there's been plenty of capital in the market. But because of those losses, profit levels have been impacted quite significantly for many insurers. And most of the large named insurers around the world, the likes of AIG, AXA XL, excuse me, Berkshire Hathaway, they've been operating at combined ratios. Now, combined ratio is the measure of claims versus premium. Claims have outstripped premium, so the combined ratios have been in excess of 100%. So what that means is that underwriting has been unprofitable. The insurance companies have relied on investment income to actually turn an organisational profit. They're the two major factors, but you know the other two quadrants of the diagram here, I've got changing appetite and environment. Because of the downturn in claims, that changes an insurer's appetite. They want to try and get a better return. They want to make sure that they're de-risking their business and they're writing profitable business. So they change their appetite. They look to try and back out of certain industries or loss-leading products for them. And you know, a good example of that is probably the food and beverage industry. So there's been a number of losses in recent years attached to expanded polystyrene construction. So it's expanded polystyrene is a great construction material for temperature control. Used in refrigeration, etc. But it burns very easily, and there have been a number of fires, both locally and globally, associated with those materials. All of a sudden, insurers start to really wind back their appetite and capacity for such risks, and pricing increases. It's a supply and demand issue. And look, finally, environment. That's talking more around regulation and tax. So in New Zealand, in particular, there's a lot of regulation change going on in the insurance industry at present. And look, that brings positives and negatives. On the positive side, insurer behaviour is becoming a lot better. And that's the focus of that regulation. But equally, when you go through regulation change, it brings greater cost to the insurer's business. And ultimately, those costs get passed down to policyholders. If we move to the next slide, I guess just to draw on some trends and what we've seen for the first part of this year. The New Zealand insurance industry, it started to change at the back end of 2016 as a direct result of the Kaikoura earthquake. insurance pricing started to go up. Capacity was slowly starting to reduce as well, particularly in regions like Wellington. And we've now had pretty much 3 straight years of increased pricing in the property insurance space, or your material damage, business interruption. There's been constant uplift. Look, all of the signs at the beginning of the year would suggest that stability was coming back into the marketplace. Most insurers had made the change that they needed to around rating to get back to technical levels where they felt that they would be able to write business sustainably. All of those signs were there. Look, the international marketplace, though, lags the New Zealand marketplace, and the reason for that being that the New Zealand, Kaikoura, whilst that was the need for change in the New Zealand marketplace, Kaikoura to the global insurance market was a bit of a speed bump. What really changed the international marketplace and the likes of Lloyd's of London, etc., was those hurricanes that I referenced earlier. That was 2017 was the largest year on record for losses for the insurance industry. So there's been about a 12-month lag. So for clients that have actually got a piece of their insurance program, both in the New Zealand market and in the London marketplace, they will see this divergence in pricing at present, where we're able to get better outcomes here in New Zealand than we are in London at this current point in time. But I guess, as I mentioned, there are these industries, though, that are still challenged. We have started to see, for the most part, stability starting to come back into the marketplace, but it's those industries like food and beverage that I just mentioned that have actually kind of been the, have seen greater than average pricing uplift, I'd say. But maybe if we move to the next slide, I'll just talk to what COVID means for the New Zealand industry and what we're starting to anticipate as we move forward through the rest of 2020. Look, mostly there's going to be two key impacts. The full impact of COVID isn't yet fully understood or known for the insurance industry. But what we do know is that there's going to be 2 major impacts. There's going to be an investment impact first and foremost. The insurance industry accounts for, globally, it accounts for about $2 trillion worth of investment. Now, as we all know, most investments over the past 2 months have not performed particularly well. Insurers have, unfortunately, what this means for them is that their investments have reduced. That impacts their solvency ratios that are required under regulation that they need to keep to particular levels. So they're recapitalising and making sure that they do remain and trade solvent and stay at the levels that are required by their national regulator. So that ultimately, that brings cost, but then equally, when there's questions on solvency, it starts to draw the ire of the ratings agencies of the world. Now, AM Best and Standard & Poor's have pretty much put every insurance company in the world on a negative watch at present, and have actually downgraded a handful of insurers to date. When an insurer gets downgraded, it means that they can't write as much premium as they did in the previous year, which essentially means that they are reducing, that the capacity available in the market reduces. In time, if there are any more downgrades in rating of large global insurers, we will start to see a real supply and demand issue in the marketplace. I've already mentioned that up until now, the market has been full of capital. It's had enough capital to be able to withstand some very large loss years. This investment impact has the potential to actually reduce that capital to the marketplace. The other impact coming out of COVID is going to be on the claims front. And look, at the moment, we understand that in the London marketplace, which is essentially the centre of the world for insurance, there's about 14 classes or products in the of insurance that will be impacted by COVID claims. Those that we've immediately immediately seen have been in credit insurance and event cancellation insurance. And, you know, think of the Olympic Games, you know, are going to be delayed. That comes at a cost to the industry in the hundreds of millions of dollars. In the property insurance space, ambiguity will be tested in courts over the next few years, so that the full impact from a claims perspective won't be known for a number of years. But a number of commentators and, you know, well-positioned industry executives are putting the loss to the industry as being the largest loss to the insurance industry out of any one event, and putting it north of $200 billion potentially, and which is quite significant, and basically means that it's almost double what 2017 was, which has been the largest loss here on record to date. So those will essentially be the immediate impacts to the industry. What that means is we're going to continue to have very choppy trading conditions as we move through 2020 and into 2021. Pricing will continue to have, there will be underlying uplift in pricing for at least another 12 months, if not longer. And there will be scrutiny of policy wordings, and where potentially coverage was provided for the likes of contagious disease will most likely be removed entirely, or is being removed entirely at present. I'll pass over to Don to take you through some of our renewal strategies.
Thanks, Justin. Listen, this is, and this presentation is based a lot on property, but we also know there are other issues out there in terms of liability concerns and those sorts of things, and more than happy to talk about questions and strategies around that at some point. This isn't a fully extensive list of all the strategies we're going to adopt. It's just a suggestion about where you can start engaging with your broker, your supplier, your agent, whoever it is that you deal with to get the insurance across the line, to try and minimise the impact on both coverage and pricing. In terms of renewal tips, just sort of giving you a heads up as to what sort of things insurers are looking for, and talking about timing and the quality of the data. So you could say, well, when's the best time to start having the conversation with my insurer about renewals? The answer is the earlier the better. If your policy doesn't fall due until 6 months from now or 9 months from now, I'd still be starting to talk to your insurance broker or agent about the strategies you want to adopt to get the best position possible when you come to actually renew your policies. The engagement piece there, you need to start thinking about what's important to your business. What can you, what can you achieve? What do you want to achieve out of that process? So, let's have a look at ideas around what the quality of the data you can provide your insurer is going to be. So, do you have up-to-date valuations? Do you have engineering surveys available that you can provide to your insurer? Do you know enough about the soil quality that your property stands on? What is your fire protection? What is your security? What are your processes of quality control? All those things need to be considered, and if you can get your insurance broker or advisor to help you put together those documents, you have a much better chance of obtaining preferential terms from the market as far as that's concerned. Look, there are always going to be hotspots geographically in New Zealand where sometimes those things don't make as much of a difference as we possibly want them to. Wellington obviously being the obvious one to start with. But the quality of data will help you get the outcomes you need, whether it's around pricing or whether it's around actually getting the capacity to insure your businesses properly. Claims history accuracy is really, really, really important. I can't stress that enough. As I say, going back to looking at, particularly if you've got a liability exposure, what are your health and safety practices? Can you document those? Can you show the insurer exactly how you're ensuring both the health and safety of your customers and also your employees? So all those things are vital in terms of painting the right picture for your insurance partners. So I don't think Kev's made the call. So we'll move just straight on to some additional strategies, and talking also about the familiarity you should have strategies other than the higher deductibles and things like this. What are you using these premises for as it stands at the moment? Would you replace them in exactly the same way they are now? Looks like my internet's giving out a wee bit. Okay. Would you put the buildings back together again now exactly as they were? Would you repurpose them for a different purpose if you had a major loss? Talk to your insurance broker about this. Can we get a better solution by actually looking at an agreed value with your insurance company? Because, you know, particularly if you've got, say, an older building that you know, different construction materials that would be used today, it might be a cheaper value in terms of rebuilding a modern replacement. I'm not saying this is an easy conversation. Insurance companies aren't necessarily terribly keen on messing around with values. They like the old traditional way of doing replacement through valuations. But, you know, the industry is going to change, and it's changing very rapidly, and the insurers need to come along for the ride with that as well. So it's always worth having that conversation, making that challenge. Deductible options, what can you afford to self-insure? You know, if you want to cut out all the minor claims and you can afford higher deductibles, that will also give you an option in terms of trying to look at managing both the pricing that you're achieving, but also potentially the ability to obtain capacity in the market as well. Can you look at loss limits for multiple locations? So if you have multiple sites and the maximum value at any one site is X, say $10 million, what is the maximum exposure you've got to a potential loss? Can you manage that exposure and those sums insured with your insurer to actually make sure that you're not paying for something that you'll never use as far as capacity is concerned? And again, you know, challenge your broker, make sure they're looking at the right markets. You know, different insurers have different appetites for different kinds of risks. It's well worth making sure that where your business is being offered is to markets where it's actually desired, as opposed to just trying to lump everything together to try and get a combined, you know, a combined deal or whatever it might be. And there are a couple of different things too. You can look at your business interruption, whether it's loss of profits, loss of revenue, loss of rents, whatever it might be, looking at, you know, what are the impacts going to be over the course of the next 12 to 18 months to 24 months even, and looking at your sums insured to make sure they reflect that, but also making sure you have an adequate coverage period in terms of your indemnity value, which is essentially the period of time the insurer will cover your loss for profits or rents or whatever it might be following the initial material damage loss to your premises. And are there other ways you can look at passing some of this cost on? If you lease buildings or premises to other businesses or other individuals, can you pass some of those costs on across as part of your tenancy agreements? I'm not saying it's a desirable thing to do, it's just something that may be worth considering it at any level. So, you know, if you are required to get valuations, can you get your tenant as part of the agreement to either part pay some of that cost or all of it? Or again, you know, are the tenants going to be responsible for getting the insurance on the building? So those sorts of things need to be considered. Again, I think in today's world, it's really vital that you are familiar with the technicalities of what your policy covers. Now, I'm not suggesting that you become an insurance expert or anything of that nature, but you should be sitting down with your insurance provider and looking at your wordings and making sure that you have full adequate cover and a full understanding of what's covered and what's not covered. You know, you need to look at what the individual insurer's definition of the insured property is. Is it, you know, just the building? Is it the contents? What does it extend to? What are the sublimits within the policy? Because they're quite important. You know, so for example, most material damage policies, i.e., you know, buildings, contents, those sorts of things, will have a sublimit for contract works or extensions or changes to your policy, to your premises. But they'll have a finite limit, and usually it's a relatively low limit, might be $500,000, might be $100,000. The minute you go $1 over that limit, the cover doesn't apply anymore. So you need to look at making sure that if you're looking to extend your premises to change things, that you have the adequate contract works insurance in place at the time you do it. Looking at the exclusions in the policy and what's covered from flow-on damage. So you have a number of things that are excluded under a material damage policy as standard. Boiler explosion, for argument's sake, is one of them. The resultant damage from that explosion will be covered, but the actual damage to the boiler won't be. You can take specific insurance for that. But what are your risks and what are you looking at in terms of the potential of those things happening? I don't want to go into all of this stuff, in great detail, but there are things that you need to consider that are really important, that if you don't understand them, you're going to have a bad surprise when it comes to having a claim at some point in the future. Bear in mind, and the one I will touch on is the natural disaster deductible, which is now a percentage of site value. So that's the total value of assets that you have insured at the site, so buildings, contents, stock, all that sort of stuff. And generally that varies depending on the region you're in. So from Wellington, for example, if your building is post 1936 it's not considered to be prone, you'll be paying 5% site deductible on the total value. If it's if it was built prior to 1935, more than likely you have a 10% site deductible. And those are things you need to build into your balance sheet in terms of your losses and exposures going forward as well. So please do have a look at what you've got in your policy wording, the technicalities. Talk to your broker, your advisor about it. Just make sure that you don't get any surprises when you come to having a claim. That's the worst thing you can do. And just to throw out a few things that Marsh do slightly additionally and have some resources available that some of our competitors don't, around trying to help moderate claims or assist with avoiding claims as much as possible, and also for reducing costs. So valuations are very important in terms of making sure that they are being considered correctly in terms of how we're applying the charges for fire service levies. So it's our responsibility, or your responsibility, to pay a fire service levy. It's based on what we call the indemnity value of the property. But there are items in the valuation that you do not have to charge fire service levies against. So check with your insurance provider and make sure that you're being charged adequately, correctly on the fire service things. That can be a big saving if it's being done correctly. Surveys struggling to be taken at the moment, obviously because of the COVID restrictions. That may ease up, I guess, as we move through level 2 and into level 1. But we do have the capability of being able to provide virtual surveys. So we have our surveys online, can access the right data relating to buildings or whatever it is you're looking at getting valued or assessed in a virtual sense. So you don't have to have any exposure to COVID or anything like that. We have a group of people, our Marsh Risk Consulting, that will help you look at recovery and preparedness in terms of addressing business continuity frameworks and plans. And the last one's, particularly a free one, which is great. We've got a whole raft of different information sources that we can give you to access at any stage. So if you ever get an email from a Marsh person at the moment, there'll be a link at the bottom of our email signatures that takes you straight through to our hub of information, which is based mainly around COVID at the moment, but we have a number of other risk consulting websites and information sites that you can sign up to that will give you up-to-date details of things that are happening in the market on a global perspective. So that's just some of the things that are in the Marsh toolkit there. So look, I think we're getting pretty close to the time limit that we had here, so I apologise if we've gone a bit over, Steve, but certainly open it up to any Q&A that we've got at the moment.
Yeah, perfect. All right, thanks Justin, and thanks Don. There was a very good overview of firstly the big picture of insurance and what's happening in the international picture in the market, and Don some really good advice and strategies there on how to get preferential terms, and lots of good advice and tips, so thanks for that. Yes, you're right, we're nearing time, but we do have time for Q&A, so participants, please send your questions through. We have some here, so we'll kick into those. First one here, we run a tourism activity. Because our clients can't get insurance for the cancellation of activities in their holiday package, they have cancelled an advance booking with us. Our main reason for not running a trip is due to weather, and we offer a rebooking option. Do you think our clients will be able to get useful insurance coverage again anytime soon?
Yeah, I'll answer that one if you like, Steve. Look, the cover, most, I suppose most of your clients will be, looking to buy travel policies or event cancellation policies, which are just I guess a narrowed version of a travel policy. Most policies have a pandemic exclusion to them, which is why essentially they're not able to make a cancellation related to COVID-19 at the moment, because the World Health Organization has declared COVID-19 a pandemic a couple of months ago now. So any cancelled travel associated with COVID-19 is essentially a policy exclusion. In general, I'd say in general, there will be some products out there where it may not be necessarily, but for the most part, insurance is there to cover the unknown and not to cover known circumstances. So COVID-19 is now a known circumstance. So anyone from, since we went to lockdown onwards, their travel policy is not going to cover a COVID-19 situation. It would cover any other situation so long as it's not a pandemic. So, whether they cancel due to their own ill health for something arising not COVID-19 related. So sorry, a bit of a long-winded answer there, but look, travel insurance is available. COVID-19 cover is not available, unfortunately.
So, Justin, I wonder whether the thrust of the question was also around event cancellation insurance and whether that market is likely to be impacted and to survive into the future, given what you said about the Olympics and the massive losses that are coming up from that. Where do you see that market going?
Look, I think the event cancellation market will remain, but equally, what we're seeing on all classes of insurance at the moment is exclusions around pandemics, around infectious disease, and this is quite typical of the insurance market, unfortunately, is every time that there's a loss, the approximate cause of that loss becomes excluded immediately until the market can fathom what the impact has been, and then it will slowly start to open up over time and start to provide that cover again. So a great example was SARS back in the early 2000s. That's what first introduced infectious contagious disease exclusions to policy wordings in this region. Slowly over time, we were able to buy the cover again. The market started to offer it, some years later, and now it gets taken away again because claims have been made against it. So event cancellation insurance will remain, but again, related to disease, infectious contagious disease, illness of that sort, I believe will remain excluded for at least another 12 months.
Thanks, Justin. I'm mindful of time, but we'll take another question. COVID is a pandemic and not covered. However, if customers couldn't get to our business and inaccessibility is covered under our business interruption insurance, would this provide an avenue for a claim?
So there are sublimits within current policies that talk about premises being closed due to requirements of the government, so local government or national government requirements to close a building due to a threat. The issue with that is, again, there's always a pandemic exclusion that wipes out that cover, or generally, sorry, I won't say always, because there will be some circumstances where there may be cover available. And the cover is usually limited to a very small percentage of the overall sum insured within that policy as well. I would like, so the general thing with a business interruption policy is it's predicated on material damage occurring for the loss of profits to kick in, so that generally a fire or a flood or whatever it might be in terms of that, something physical happening accidentally to the premises that stopped you from being able to access them. As I say, the pandemic exclusion tends to wipe out any additional cover you've got on your business interruption, but which was fairly limited at the start. But going back to Justin's point, I guess, is all this stuff's been really restrictive or not available since SARS, in a similar way that terrorism cover suddenly became a massive issue after 9/11. So, I mean, at the time I was living and working in the UK, and the minute that happened, terrorism cover was a freebie with everything you had in your policy. From that moment onwards, it became a dreadfully expensive and a very restrictive cover to purchase. So the short answer is, if you really want to test it, talk to your insurance broker or your provider, and put it in front of the insurance company to make the decision. My general view is that you'll find that it's probably not covered.
Great, thanks, Don. All right, we'll draw it to a close there. Certainly, if if attendees have any more questions, please send them through and we'll forward them on to Marsh. Adam, or who would be, are you the best contact if someone wants to get directly in contact with Marsh at the moment?
Yeah. We're going to send a follow-up email, which will have my contact details as well. So just shoot through to me. You've on the slideshow in front of us now, you've got Don's and also one of our business development managers, Wayne. So either one of those emails, and we'll be able to point you in the right direction.
Perfect. All right, thank you. Cool. Just some closing comments from me. Thank you to our members for participating today and your questions, and thank you all also to our presenters from Marsh, to Justin, Don, and Adam. The webinar will be available on the TIA website by the end of tomorrow, and also a reminder to visit our COVID-19 pages on the website. There's lots of current information, advice, and support for operators. Also, if you have any particular queries just in regards to business support, please get in touch with us either via info@tia.org.nz or call us also to discuss. Our phone numbers are on our TIA website contact page. And lastly, next week's Discussing Tourism webinar is the government support programs. So the webinar will discuss support available to businesses to help them through the COVID-19 crisis. This includes the extension of the wage subsidy, the tourism advisory support services, and the strategic tourism assets protection program. And as well, there'll be an update on the tourism task force. So that's next Thursday, the 4th of June at 2 p.m. and you can register on the TIA website. And to close, kia tau, kia tātou katoa, te aio, te aroha, me te maruto. Tihei moriora. Thank you, everyone.